Have you ever wondered why the price of Bitcoin fluctuates wildly every 4 years? Well, the answer lies in an event called Bitcoin halving. This event, coded into the very DNA of Bitcoin by its mysterious creator, Nakamoto Satoshi, is designed to control the supply of Bitcoin and prevent inflation. Let's delve into the history and the fundamentals of Bitcoin halving. In the world of Bitcoin, miners play a crucial role. They validate transactions and add them to the Bitcoin blockchain. In return, they're rewarded with a certain amount of Bitcoin. This is where the concept of Bitcoin halving comes into play. Originally, this term was used primarily among miners. Nakamoto Satoshi, in his wisdom, coded the Bitcoin network to halve the reward miners receive after every 210,000 blocks are mined. This event, known as Bitcoin halving, occurs roughly every 4 years. The purpose? To create scarcity and to gradually eliminate inefficient miners from the network. Since the inception of Bitcoin, we've witnessed 3 halvings. The first in 2012, the second in 2016, and the third in 2020. With each halving, the reward for mining a new block is reduced by 50%. For instance, the reward decreased from 50 to 25 bitcoins in 2012, and most recently in 2020, it was reduced to 6.25 bitcoins. The impact of Bitcoin halving is profound, especially on the price of Bitcoin. As we've seen in the past, a few months after each halving, the price of Bitcoin has surged dramatically. This is due to the simple economics of supply and demand. As the reward for mining new blocks is halved, the supply of new Bitcoins decreases, leading to a potential increase in price if the demand remains strong. So that's what Bitcoin halving is. A programmed decrease in mining rewards that happens every 4 years. It's a fascinating mechanism that plays a significant role in the world of cryptocurrencies. Stay tuned for the next segment, where we'll delve deeper into the mechanics of Bitcoin halving. But how does Bitcoin halving work, and why does it happen in the first place? Let's delve into the nuts and bolts of Bitcoin mining, the halving mechanism, and its impact on Bitcoin's total supply, and the concept of scarcity. Bitcoin mining is a process where miners validate transactions and add them to the Bitcoin blockchain. They do this by solving complex mathematical problems to unlock new blocks of transactions. In return for their efforts, miners are rewarded with a certain amount of Bitcoin. This is known as the block reward. But here's the catch. To control inflation and ensure the longevity of Bitcoin, the creator, Satoshi Nakamoto, devised a clever plan. He coded into Bitcoin's DNA that after every 210,000 blocks mined, the block reward would be cut in half. This is what we refer to as Bitcoin halving. Approximately every 4 years, this halving event takes place. As the reward decreases, it makes Bitcoin harder to mine, creating a sense of scarcity. This scarcity is a key element that drives Bitcoin's value. Let's take a quick trip down memory lane. The first Bitcoin halving occurred in 2012, reducing the reward from 50 to 25 bitcoins per block. Fast forward to 2016, the reward was halved again to 12.5 bitcoins. Then in 2020, miners were left with only 6.25 bitcoins per block. With the upcoming halving event, the reward will shrink further to just over 3 bitcoins. This halving process will continue until we reach the maximum limit of 21 million bitcoins, a milestone expected to be hit around the year 2140. So what does this all mean? It means that Bitcoin's supply is finite. It's designed to gradually decrease over time until no more bitcoins are left to be mined. This controlled supply creates scarcity, which in turn helps maintain and potentially increase Bitcoin's value over time. As we can see, Bitcoin halving is a deflationary mechanism designed to control Bitcoin's supply and maintain its value. So what happens to the market when Bitcoin halves? To put it simply, we see a significant shift in the supply-demand dynamics, which plays a significant role in determining Bitcoin's price. Let's take a step back and consider the previous halving events. After the first halving in 2012, Bitcoin's price jumped from $12 to nearly $1,000 in less than a year. A similar pattern followed the second halving in 2016, with the price rising from $670 to a whopping $2,550 in just a year. Then, it skyrocketed to $19,700 later that same year. Now that's quite a leap. So what's the deal? Why does the price increase after a halving event? Well, it's all about supply and demand. When the halving occurs, the reward for miners is cut in half, which essentially means that the rate at which new bitcoins are created and enter the market is reduced. This decrease in supply can often lead to increased demand, as the fewer bitcoins there are available, the more valuable they become. But it doesn't stop there. The anticipation of this increased demand often leads to a surge in buying activity before the halving occurs. This influx of buyers, coupled with a decrease in supply, can result in a substantial increase in Bitcoin's price. However, it's essential to remember that these price increases aren't immediate. It can take months for the effects of the halving to fully permeate the market, but when it does, it's a sight to behold. In conclusion, the Bitcoin halving isn't just a significant event for miners, it's a pivotal moment for the entire market. The reduced supply of Bitcoin can drive up demand, leading to a potential price increase. It's a fascinating example of basic economic principles in action. Bitcoin halving has a significant impact on its price due to changes in supply and demand dynamics. However, Bitcoin halving is not without its challenges. The first of these is the environmental impact of Bitcoin mining. As the algorithmic difficulty increases, miners are forced to ramp up their processing power. This results in a higher energy consumption, which has been a long-standing criticism of Bitcoin mining. The energy required to power the mining process is substantial, and with each halving event, this consumption only grows. In response to the outcry over Bitcoin's environmental footprint, some argue that the pressure to remain profitable is driving miners to explore more sustainable energy sources. Solar power, for instance, is being touted as a viable alternative. Moreover, the advent of next-generation mining technology may also contribute to energy efficiency. Despite these potential solutions, the reality is that Bitcoin's energy consumption remains a contentious issue. The second challenge posed by Bitcoin halving is the risk of centralization. With the increased competition brought about by halving, smaller miners may find it difficult to stay afloat. This could potentially lead to a concentration of mining power in the hands of a few large-scale mining operations. Data from BTC.com between 2016 and 2021 reveals that the two largest mining pools regularly controlled between 30 to 40% of the network's hash rate. Such centralization could undermine the very principle upon which Bitcoin was founded: decentralization. If a small number of entities control the majority of the mining power, the network becomes more susceptible to manipulation. This could erode trust in the system and potentially destabilize the Bitcoin network. In conclusion, while Bitcoin halving can lead to increased profitability and scarcity, it also presents significant challenges. The environmental impact of Bitcoin mining is a serious concern that needs addressing. The potential for centralization, too, is a threat to the core values of the Bitcoin network. While Bitcoin halving has its benefits, it also poses significant challenges, particularly in terms of environmental impact and centralization. So, what does all this mean for the future of Bitcoin? Well, the Bitcoin halving mechanism illustrates the ingenuity of its design, where scarcity is built into its code. As we've seen, halving events can have a significant impact on the market, often leading to a rise in Bitcoin's price due to the reduced rate of new Bitcoin entering circulation. This has been observed in the past and is likely to continue as we approach future halving events. However, it's important to remember that while scarcity can drive up the price, it's not the only factor at play. Market demand, investor sentiment, regulatory changes, and technological advancements also play a crucial role in determining Bitcoin's value. For investors, understanding the dynamics of Bitcoin halving can provide strategic insights. The anticipation of price increases following a halving event could be a potential opportunity for investment. However, Such decisions should always be made with a comprehensive understanding of the market and its inherent risks. For miners, halving events pose a more direct challenge. The reduced rewards mean that only the most efficient mining operations will remain profitable. This might lead to a further centralization of mining power, which could potentially threaten the decentralized nature of the network. It also highlights the importance of renewable energy sources and energy-efficient technology in maintaining the sustainability of Bitcoin mining. In conclusion, Bitcoin halving is a fundamental aspect of Bitcoin's design that continues to shape its future. The cyclical nature of these events provides a predictable rhythm to Bitcoin's economic model, but it also brings challenges and opportunities that affect all participants in the Bitcoin ecosystem. In the end, understanding Bitcoin halving is crucial for everyone involved in the world of cryptocurrency, from miners to investors. It offers a glimpse into the future of Bitcoin, helping us navigate the complex and ever-evolving landscape of cryptocurrency.